A popular accelerated depreciation method is known as a declining balance method. To review the different methods, it can be based on time as straight line or an accelerated declining balance. Sum of the year's digits is another fourth method, or activities based on the actual units produced or the actual activity. And then when you think of, there are hybrid ones, think of makers, IRS depreciation method. And it's a hybrid because it begins accelerated and then it converts to straight line towards midlife. There are many, many different IRS depreciation tables, and it's because there are so many complex rules in tax accounting, but we're focusing on the financial side of this. So an example, demonstration accelerated method. It is 3 steps. Think of it as 3 steps. First, you convert the life to a percentage. Multiply that by 2 if it's double, or it doesn't have to be double. It can still be a declining balance method if it was, let's say, 1.5 or 1.75 or even 2.5. But a popular one is the double declining balance method. And then once you get that double amount, then you multiply the current book value, whatever that is, by that amount. So this differs from some of the other methods because you don't focus on salvage until the end, where you do think about salvage in the beginning with straight line and units of production. So step 1, convert the life to a percentage. So what does this mean? Well, you start out with 100% of its life. If you estimate 4 years, that's 25%. Using the double declining, we double this, 50%, and you multiply that by the current book value. And book value is going to be cost in the very beginning because you're not considering any salvage in the beginning, even though there may be. So the first year, $25,000. You can see it's very high in the first years in the declining balance method. Here's your entry and how it looks on the balance sheet. Second year, now what is your book value at the beginning of this year? It's $25,000 because you've already depreciated $25,000. Multiply it by the same percentage, and you notice how the depreciation was really cut in half every year when you're using such an accelerated method. Again, the expense on the income statement and how it appears on the balance sheet. Look at your book value now. Third year, again, it's going down. Depreciation, the balance sheet. Then in the fourth year, but look at the numbers. If I use that full 50% in the final year, I'm going to depreciate below book value. Can't do that. So what do you do in that final year? You have to watch very carefully what the current book value is and adjust that final year because you cannot depreciate ever below your estimated salvage unless you make a change in estimate and decide there won't be a salvage. But there's your expense and your balance sheet. Finally, book value after it's fully depreciated should equal your salvage. Look at these columns and think about this when we get to another video looking at the sum of the year's digits. Look which number stays constant and which one changes. The percentage does not change, but the book value is the declining balance. You see the book value is gradually, or actually rapidly declining. That's why it's called this method. And terminology review. Service life versus legal life. You're going to depreciate it over how long you're going to use it. Allocation base, this is also called depreciable cost. How much of the total cost can be depreciated? So this is cost minus salvage, cost minus residual value. And that gives you your allocation base. Allocation method, well, you have a choice of depreciation. You can use a time-based method, one of the many, or you can use an activity-based method. Plant assets, you call it depreciation. With natural resources, you call it depletion. And with intangibles, you call it amortization. But we're talking about an expense. Key to remember, it is not valuation. And this can be confusing because then you're focusing on the balance sheet. You have your plant asset less accumulated depreciation to give you that book value. But Don't confuse that word book value with valuation. We're talking about a cost allocation. That's what this is.